We'll take a look at those PE multiples, because that's the main one. That's the headline that we're hearing right now, which is price to earnings multiples, the price divided by the earnings of expected earnings, are elevated, and they are. The PE on the S&P 500 is at over 22 times earnings. Really only seen that a few other times in history, and those weren't great times for the market. The median PE on the S&P 500 is not as elevated. So it gets you to what we were talking about. Those large companies' PEs are pulling up the rest of the index much higher, but the median company is significantly lower than that at only 18 times. That's the red line, elevated but not extreme as some of the blue line has been there. Another way to look at this, and this is a terrible indicator for timing, it's just to show expected growth, which is the PE divided by the growth rate, the PEG ratio, which is to say if you do get the growth, is it a reasonable price to earnings? And it is. At 1.25 roughly is a reasonable multiple if we get the growth. It's conditional on the growth, right? You can look back historically in 2021, you didn't get the growth, and it was not a reasonable PE. And there were other times where in 2012, PEG was low, which is a good thing, and you did get the growth, fantastic returns for the market.
Right, so it's price to earnings certainly matter, and we are paying a premium for earnings. Something's got to happen. Price has got to come down or earnings has to go up. And when we look at that PEG ratio, which is the price to earnings to growth, it's saying that the growth of earnings is what's going to change. So the earnings, the E is, based on this data, is what is expected to change, not the price.
Right. Another alternative way of looking at it is looking at a global index. This is the all-country world index, not nearly as elevated. International stocks are not trading as high multiples, and domestic small and mid-cap are also not trading at high multiples.
And I think that's an important case to make, is that PEs across the globe are not elevated. PEs in the U.S. are elevated. So you have the option to go buy lower PEs, but you're not doing it. Why is that? That's because people are seeing that there is a growth potential and a premium to pay for U.S. stocks for a reason. Now, history is going to tell us in the future whether that's a right call or not. But there are just as many bullish cases to make here as there are bearish cases. Once again, you talked about the playbook. Don't just play a playbook because it's shaped out like that before. Understand what's driving that and what may be different in the playbook.